And on behalf of Bajaj Capital Limited, I welcome all of you to the millions of viewers and investors of Bajaj Capital Limited on this special program on one of the most important events in the financial markets, which is the Union Budget 2024. So today we would discuss the main highlights of the budget and what is the impact of it on on us as a common people of the country as well as investors and taxpayers of the economy. So it's my pleasure to welcome my guest also for the evening. I think Mr. Sanjeev Bajaj is here with us today. Mr.
Yeah, hi Uttam, it's great to be here, and my apologies on behalf of my team for keeping everyone waiting. So that puts additional pressure on us to
Yes.
be so good that we add value to your life and we give you, concrete opportunities to make money from this budget, and that's going to be our aim, and we hope that we are able to deliver it to you.
Yes, absolutely. Well said, Sanjeev ji, and we'll try our best to make it as interesting and as relevant as possible for our viewers. So once again, I welcome you on this program. It's a pleasure meeting you here after a long time. And for our viewers, Mr. Sanjeev Bajaj is the Joint Chairman and MD of Bajaj Capital Limited, one of the largest investment advisory houses in the country with over 5 million investors. So thank you. And before I start, let me also check if our other guest, Mr. Gautam Duggad, is here. Okay, I can see his screen is now on. I can see him now. Welcome, Mr. Gautam Duggad. How are you?
Thank you, sir. How are you? All good. Good afternoon.
Good, thank you.
Good afternoon, Mr. Rajat.
Yes. So
good afternoon, Gautam. Great to have you with us.
Thank you.
So for our viewers, just a quick introduction of Gautam, that he is the head of research of institutional equities at Motilal Oswal Financial Services, and he has been with the company for over 16 years now, and is also an alumni from IIM Kolkata. And more than anything else, he is a very, very prominent face on the social media, on CNBC and all the other financial media houses. So, and I believe you were, Gautam, also one of the core team members for the budget group committee of CNBC this time.
Yeah. They had constituted a budget jury.
Okay.
Yeah.
That's interesting. So what was the key role and what was the key highlights for this committee?
No, we
Or the
were
jury?
just discussing before the budget what are our 2-3 key expectations. And then after the budget, they asked for our verdict as to how the actual budget was and what were our key takeaways from the finance minister's speech and the measures that she announced.
Okay, so let me start from there itself, Gautam, that what is your key takeaway from this budget? Do you think it's a pro-reform budget and it's on the way to Viksit Bharat, or do you think there were few compromises done because of the political, situation, or was it on track? How do you see it?
Yeah, so Uttam, first of all, good afternoon to everyone who's present in this webinar. It's my pleasure to address this gathering. Uttam, on the budget, the way to look at it is, it looks like a budget which is in continuity of where this administration left in the second term. There were widespread expectation that because of the slightly fractured mandate on 4th of June, there will be some populist measures which will get announced because there are 3 more state elections ahead in October and November in Maharashtra, Jharkhand, and Haryana. There were in fact, we were also expecting some measures on populism, relief, and some freebies to get announced in the budget yesterday. The fact that it didn't happen and the government continued on 2 very important, I would say, priorities. One is fiscal consolidation, and second is capex thrust. So if you look at the budget numbers in minute detail, you will find that government has completely eschewed populism, and whatever extra bounty that they got because of the RBI dividend, they have utilized it to reduce the fiscal deficit. If you recall, in February 2024, when they presented the interim budget, the government had proposed a fiscal deficit of 5.1%. In the budget that they presented yesterday for full year FY25, they have presented a fiscal deficit of 4.9%. So that's a pretty chunky 20 bips of reduction. And more importantly, it brings the fiscal deficit handle uh, below 5. So it's been a while you saw that 4 number on the fiscal deficit handle. The last time you had a fiscal deficit in the 4 handle was in FY20, 4.6%. After that, because of the pandemic, we went to 9.2. Then we brought it down to 6.7 in FY22, 6.4 in FY23, and then 5.6 in FY24. And the expectation was that this will be 5.1 for FY25. But they've used the extra dividend that they've received from RBI to sort of jack up their balance sheet further. And now the fiscal deficit of 4.9% for FY25 has been penciled in, and it makes the path extremely clear now for FY26 fiscal deficit of 4.5%, which is their commitment that they will bring fiscal deficit down to 4.5 by FY26. This is what they had mentioned in their budget 3 years back. So they are well on their path to reach that destination. Second, if you see, that is the second most important takeaway from this budget for me, which is capex. This government's overarching focus for last 10 years, if you see, has been capital investments, infrastructure, manufacturing, and PLI. And that focus continues. They had budgeted 11,000 crores for capex in their February interim budget. That number has not been tinkered with. It is still 11.11 lakh crore, which is a growth of 17%. This 17% growth is on an extremely high base. If you recall 5 years back, in FY19, the capex allocation was 3 lakh crores only, 3.07. From 3.07 to 9.5, we've already done in FY24. So that is a 3.5x jump in the capex allocation by this government in 5 years time period. On that 9.5 lakh crore, now you are seeing a 17% higher allocation. So, which is a very clear message that this government will continue driving capex spending in the economy, will not resort for short-term populist measures to prop up the consumption demand. They rather believe in driving consumption through organic manner by driving investment first and then letting those capex and investment trickle down and lift the consumption demand in a very organic manner rather than providing freebies and driving consumption demand in the short term. So those were two significant messaging from the government on their policy agenda, not just for this year. I think this will continue in their third term for another 4 years too. What I was slightly disappointed with was there was just too much of tinkering with taxes. And I'm not just talking about the capital gains tax, which the market is fairly disappointed with, but I am talking about too much of tinkering around custom duties and then changing the duration and taxation for a lot of other asset classes. I think what is required is a very stable and steady tax regime, which is very predictable, that these are the taxes is going to remain there for next 10 years and there will be no tinkering in those tax rates. So that sort of builds confidence in the investment decisions of the various market participants. So that was a slight disappointment. And of course, I would have definitely loved if the government had used part of the extra 1.5 lakh crore that they've received from the RBI dividend to sort of drive some consumption, because consumption demand has been very lackluster for last 3 years thanks to the slowdown in rural consumption. And this was a very good opportunity for government to use that capital to drive the consumption demand. They could have kept fiscal deficit at 5.1 or 5% and utilized those 30,000-40,000 extra crores that they have received from RBI to drive consumption at the bottom of the pyramid. But the fact that they've chosen not to do it will essentially mean that in the near term, you might not see any sharp spike in consumption. So those are 2 or 3 key messages, Uttam, to begin with from this budget?
Superb, Gautam. I think that was a very hardcore analysis. And this our talk show today is very interactive. So, guys, if you are writing any comment or anything, please know that it is available to the speakers. And Gautam, you can just look at the comments and you can see what people are talking, what are the questions they are asking. So I want to make it very interactive so that we can add actual value to your life. And this talk today, this 1 hour that you're going to invest with us, should add value to your wealth. And that is something I'm very clear about. So Gautam, just breaking our flow in between, there is a question by Rahul Pandey. He's asking, what's the relevance of hikes in STCH 2.5% and 5% respectively?
Yeah, so see, Sanjay, it's a very clear messaging on the political front, because see, economy is never it never operates in isolation. When a government makes a budget, they also look at the political messaging of the budget. So there was a widespread belief which was getting, you can say, getting entrenched in the voters' mindset that the rich is getting richer and the poor is getting poorer post-pandemic. There is sort of inequality. There is sort of K-shaped recovery, which is a most abused term post-pandemic in the economic parlance and the stock market parlance. But that's a reality. You've seen it in so many data points in the last 5-6 years. Any segment you take, any segment, the top end has been outgrowing the mid to lower tier by a wide margin, whether it is consumer staples, consumer discretionary, durables, any segment you take, or retail for that matter. Now, what is the logic behind this? Why 12 and a half and why not 13 or why not 15? I think government is sending a message that it is trying to sort of balance the growth and bring more inclusivity in it. So they have given some token relief measures in the new tax regime to the middle class and lower middle class section of the population by increasing the standard deduction limit from 50 to 75,000, but creating, I think, 1 or 2 extra tax slabs in the new tax regime. All of that put together results in a savings of somewhere around 17,500 rupees. I don't think this measure of short-term capital gains or a long-term capital gains is essentially a revenue sort of a measure. They are not going to get a huge jump in their revenues. For that, the security transaction tax is already there, which is giving them on a quarterly basis almost 16,000 crores of revenue. So I don't think long-term and short-term capital gains taxation is purely to drive revenue. It is more a messaging that government is looking after every segment of the population, and wherever some extra wealth has been created, they're trying to take some amount of it and redirect it towards their spending on welfareism. So that is one angle that I look at. Second is, I think they're also trying to cool off the capital markets a little bit. You've seen in the last 15 days, various authorities have come and made comments on capital markets, whether it is RBI, SEBI, then the economic survey also pointed it out that the volumes in the future and option segment of the market are too high. Yesterday also we did $7.2 trillion of F&O volumes, which is 2x of India's GDP, by the way. Now the point is, you're trying to cool off the stock market sentiments, but at the same time, you do not want to damage it. So you've done some token increase in short-term capital gains tax and long-term capital gains tax. That is how I will read it.
Yeah, but what my view, Gautam, is that this long-term capital gains is actually a mixed bag. Okay, so they have increased it from 10 to 12.5%. But what it also does is that it's giving clarity. Earlier with indexation, it was 20%. Without indexation, it was 10%. So now at least you have a clarity that, look, it's 12.5%. So it will help some people. And where I think it's very positive is on unlisted securities. Because it is very, very important in India to promote angel investing. And, we were talking about Startup India, angel investing, getting inclusivity, getting people to make money. But angel investing was very difficult due to angel tax, which has now been, removed.
Yeah.
Everybody's got arbitrary notices, etc. There was so much harassment to angels who were investing. And on the second side, this LTCG of 12.5%, the positive side is even on the unlisted securities, it is now 12.5%. Another way to look at it is that today buyback has been made tax-free. So when you invest capital into your company, you can't take it out, which is very unfortunate. Look, if I start an industry, I take 10 crores from my saving and I put it into my company. Today, the only way for me to take it out is first pay tax in the company, then pay dividend tax, then pay personal income tax. Now, the same thing has been done on buyback, which used to be earlier. So I think that's slightly negative. But this 12.5% on unlisted securities will now promote a lot of people to go in for private equity, other ways of value creation, to be able to get the capital out, to be able to raise capital. So I think it is positive on that side of the situation. But it's for me, it's a mixed bag. And there's a question that somebody's asked, that how does the budget, like Abhishek Das is asking, budget on real estate taxation, who will gain, who will lose? I've explained it a bit. But I also wanted to know that they already have a grandfathering. So, so even if your property is a legacy property bought before 2001, then that provision of doing the valuation as on 2001 is still available. Okay, you cannot do indexation post that. Now, this was a huge concern. A lot of investors are asking, look, I bought this house in 1985 at 5,000 rupees. Now, today it's worth crores. But yes, if it was worth 1.5 crore rupees in 2001 and now it's worth 3 crore rupees, then you will only have to pay a tax on that 1.5 crores. Earlier, it was 1.5 crore plus indexation. So that is there. So grandfathering is definitely there. Now, Gautam, you posted a point that this is a middle class budget. Now, there's a huge debate that who is the middle class for India. Is the middle class guy is the person who doesn't pay taxes or pays taxes up to 5 to 10 lakhs? So today, Indian middle class even earns 20, 25 lakh is a middle class. There is a lot of, I don't want to quote, but a lot of people say anybody earning more than 5 lakh rupees is high income in India. I don't think so. But, I think Indian high income today, India is reaching at levels of the market. High income for me today is a person earning more than 40, 50 lakhs. And people below that is middle income. And this budget has been very disappointing for them, that the tax relief given is only for the new regime. Now, people don't want to give up their investments. Like, why should a person not? I don't understand, why are we trying to disincentivize, say, financial security? Why are we trying to disincentivize insurance? Why are we trying to disincentivize ELSS? Why are we trying to disincentivize a person buying a house? So I think this new tax regime and old tax regime is a highly negative thing. It doesn't add any value to this. This is my personal view. What are your views on this?
No, I agree to an extent. Sorry, Uttam, complete your point.
Yeah, I just wanted to add to this point what Sanjeevji mentioned, that there's a trade-off between simplification and creating a savings habit with the investors. So the earlier regime had, created that habit of savings through various sections and created a cushion for, retirement and for later years. But in the new regime, it talks about simplification, but no, savings. So there's a trade-off. So how do you see this point?
No, I agree with the point Sanjeev mentioned. We need to have a very rational way of taxing people, because do remember, in this country, only 2.2% people pay taxes. How much you want to squeeze them is a question that will always get asked, right? One of the ideal things that needs to be done, and the policymakers and authorities need to find a way around it. How do you increase the tax base? While 8 crore or whatever 8.5 crore people file income tax returns, how many of them are actually filing zero tax returns? And what percentage of the income tax filers are actually accounting for 80-90% of income tax payment? Second point, today the absolute collection, if you see the absolute collection of income taxes on a personal tax, income tax, if you look at the personal income tax paid by people last year the individual income tax payers paid 10.2 lakh crores, whereas the corporate taxes were just 9.2 lakh crores. 5 6 years back, corporate taxes were higher than personal income taxes in absolute terms. Then in FY 1920, the government reduced the corporate income tax rates, and they didn't change personal income tax rates for a very long time now. Maybe very small minuscule changes here and there, some slabs here and there, some standard deduction, limits being hiked here and there. So net over the last 7 8 years, whichever class of taxpayer you take, middle class, low middle class, mid income, they've not received any significant sort of relief on their income. And secondly, on the indirect taxes, the GST collections have been rocketing up. We almost boast about monthly GST collection of 2 lakh crores. So somewhere, everything put together, the pressure on the wallet of a mid-income customer, mid-income salary earner, or even a business earner, businessman, that has continuously gone up to the extent that it is now pinching them. And thus, when every month, at the beginning of the month, there are a lot of celebratory headlines in media and Twitter that this month's GST collection has gone up this much, or on a quarterly end basis, there are policymakers tweeting about the net direct tax collection being up 18 20%. So somewhere, people feel too much tax is being paid, and despite the sort of growth in the economy, they've not seen much benefit in their pockets, right? While stock market wealth has gone up, we are a $5.2 trillion economy, market cap now, inching closer towards $4 trillion GDP next year. But a lot of people, and that's why I mentioned this point right at the beginning, there are a lot of people in the bottom end of the income pyramid, they are feeling aggrieved. Second, even a simple thing like income tax exemption limit or Section 80C limit has not been revised for many years now, whereas inflation has gone up. Somewhere, I mean, there has been a debate in the community for a very long time that that Section 86 80C limit needs to be tied up with the inflation, because 10 years back also you had a 1.5 lakh exemption limit on Section 80C, and today also you have a same limit. So somewhere it doesn't add up. Those are the things that obviously policymakers need to address. But in the short term, it definitely pinches, and it doesn't do any good to the overall consumption demand in the economy. And in a way, it ends up creating a one-legged horse, which is basically dependent on only investment, manufacturing, capex side of the economy.
Yeah. So Gautam, again, I have a viewpoint here that I think government has lost seats, BJP has lost seats, and they have not understood the mood of the market. I feel that they are a couple of crores of taxpayers. Each taxpayer is giving employment to at least 10, 15, 20 people. So
Yeah.
these 2 crore people are actually touching lives of at least 40, 50 crore people. And today, these people who were the core base of BJP has been dissatisfied, because there is a need for a reduction in direct taxes. There's a huge demand that corporate tax rate has been brought down to 25%, bring the direct taxes down to 25%. And the thinking is, look, if we do that, it will be taken that we are anti-rich or we are pro-rich. That's not true. If you are pro-rich, you are pro-economy. These are the people who will create employment. They'll have more money. They'll invest more. And at the end of the day, your employment, everything, prosperity goes up. I remember one time, people used to get paid measly amount of money. Today, you look at an average guy, people are making good amount of money if they are well educated, working hard. So the whole dynamics of the Indian economy is changing. And this, thing is that we have to be anti-rich to be populistic. I think this needs to change. That, I'm not talking about ultra rich. I'm talking about the rich, the normal rich people, the what we call the middle class or the higher middle class or the high income group. Why not be fair to them? Why not reduce their direct taxes to 25%? Merge this scheme 1, scheme 2, trying to promote one scheme over the other scheme. What difference does that make? Let it be one scheme. As you said, ATC limits need to go up. Let more people declare more income. Let's put a finish to this black economy and let these 40 crore people who are the core supporters of BJP come back to BJP. Okay, and I think it'll be great for them. But yeah, but that's a debate for another day. So, Uttam, some points from you. Being a hardcore wealth expert, Uttam, let me
Yes.
ask one question: that where do you feel we should be investing our money, given this budget? Are there opportunities there? There are some very interesting questions that have been asked to us. But we'll start with you, then we'll come to Gautam on that.
No, no, sure. I think it's a very relevant point. So before I come to that, I also wanted to touch upon a very quick point that, as we know, the indexation benefit has been taken away from immovable properties, assets, which is the real estate properties. So there, I wanted to highlight that most of the people, 70 to 80% people are buyers of the first property. They are buying a house to reside. So there it doesn't impact them at all. Secondly, if you sell a property and if you buy another property within 6 months, then also you can avoid the capital gain tax. So the indexation benefit will not impact everybody. It will impact only maybe 5 to 10% of the investors, but not beyond that. That is one small point which I wanted to make. So my opinion is that nothing much has changed because of this budget in terms of our investment goals or our investment styles. So equity markets still remains one of the highest, return asset class in the country, whether, the capital gain tax goes up by 2.5% or here and there, it doesn't make a huge impact on the investment cycles. I think the markets will adjust to this fact, maybe if not in a couple of days, maybe in a week or so, and it will be business as usual when it comes to equity investments. Second category which I would like to highlight, which has got impacted in a positive way, is the NPS category. Because there, for private sector employees now, the 14% deduction has been allowed, up from 10%, which is a huge,
Ah, big
uh,
big thing.
big thing, because NPS has proven over the years to be a very, very useful investment class. And most of the investors there or subscribers there have benefited in a huge way, because not only they save taxes every year, additional taxes on it, but they also make good returns of market linked returns over a period of time. So that is there, and then I don't think too much has changed beyond that. But what is your view on this, Gautam?
No, so look, as far as the points that you're raising on NPS and all, that's perfectly valid. But there, the awareness needs to be created. I mean, even in my circle, and people who are from I am Calcutta, 2005 batch, 18 years working in corporate life, very few are aware about this NPS benefits. Honestly, I've shifted to NPS 7 8 years back in 2016, and I can tell you before that I was not aware that this is such a good tax saving tool. And to add to that, I had selected equity option there, with a 70% contribution of equity within NPS. Today, NPS is giving me, after 8 years, a decent 15.4% XIRR with 30% debt, right? So not many people are aware about it. And of course, while the economic survey did mention about the fact that there are some dangers because of the excessive speculation, but there was also an unwanted reference to the financialization of savings. I think as a country we need more of that rather than less of it, and the journey hasn't even begun. If you look at FY23, because that's what the data is available and updated till, the total allocation to equity in India is just 4.7%. So there is a very, very, very long way to go for a lot of people in this country to traverse that equity journey. So anything which is done to raise equity allocation should be welcome. I know there is a lot of noise about banking system facing problems in deposit accretion. But I think it is more to do with the way banks have run themselves. If you expect a lot of deposits to accrue to you at a 5%, 4.5% post-tax rate after inflation, in an era where these social media and fin influencers and all of them are becoming so relevant part of the daily narrative, somewhere the deposit momentum was going to get a slack, and that is happening right now because a lot of people who have seen the way equity markets have performed for them in the last 4 5 years after they started doing SIPs, they're quite happy with that. Instead of locking the money for a 4% return in fixed deposit, people are happy even if they're getting 12 13% from even index funds. So, today the nature of an investor has changed. March 20, when you had 3.5 crore demat account, and June 24, when you have 16 crore demat account, that tells you a
Yes.
lot to the character of the new investor who has come in. If you recall, one of the data points of 4th of June, when election results were coming in and there was a shock reaction in the market, that day's data, if you see, institutions sold 13,000 crores of equity that day. But it was a retail investor who's bought 21,000 crores of equity, right? Usually, and we have mentioned this point in our last strategy report that we published in July, we've actually given it a title of Retail Rhapsody, wherein we very prominently
Yes.
highlighted that in the past it was always believed that a typical retail investor always comes at the top and sells at the bottom. And that has been changed, that has been turned upside down now, and we've all been witness to it. Last 30 months put together from 1st January 2022 till 30th of June 2024, that is 30 months cumulatively, the total FII flows are $8.3 billion, out of which $6 billion have come in last 45 days. So till about 31st of May, it was virtually zero. That is 2.5 years put together, I'm saying. Versus that 8.3 billion in the same period, the corresponding DII flows are $83 billion. So 8.3 and 83, almost 10x jump. So the relevance of a domestic retail investor has gone up manifold, which is reflected in multiple other data points: the domestic shareholding, the weight of India in MSCI indices. Our weight has gone up from 9% 4 years back to almost 18 19% now. And every now and then, more and more free float is getting generated as private equities promoters sell their shareholding, and which is resulting in a bigger free float for a lot of those big stocks, which is resulting in a weight up in a lot of other global indices like MSCI, FTSE, and all of that. So my prognosis is that this is a journey which has just begun, and what is commendable is that this accretion in market cap, has been backed by a very solid underlying corporate fundamentals. We had put out a note a week or two back, which had gone viral, wherein we had just stated few data points. We said that Nifty, on a 5 year basis, FY19 to FY24, the market cap has compounded at 18%. And the Nifty earnings have also compounded at 18%. Right? The Nifty as an index, the Nifty 50 benchmark index, we don't see any froth there. We actually feel there is no bubble. The market has behaved very rationally, compounded at 18%, with an underlying earnings compounding of also 18%. It is the mid cap and small cap where there has been expensive valuations which have been prevailing for some time now. The similar data, if you look at mid and small cap, the gap between market cap growth and profit growth is too high. Just to give a simple data point, mid cap index X of financials last 5 years, earnings have compounded at 17%, market cap at 27%. Same data for small cap, earnings have compounded at 8% for small cap index X financials, but the market cap is compounded at 28%. So today the mid cap index is trading at 60% premium to Nifty, which has not happened in the last 15-20 years. So clearly there are pockets of excesses which are getting built in mid and small caps, but the broader market, the broader larger market cap index, which is Nifty, there things are quite normal. So like I said, there are so many things which points you to the direction that as you move forward, as the economy grows from 3.6, 3.7 towards 8 trillion in the next 5 years, the market cap can also keep pace. Today we're at 135, 145% range in market cap to GDP. What if it moves to 150%? And market cap itself, GDP itself moves to $8-10 trillion in the next 5 to 7 years. You're then talking about $15 trillion market cap at some point of time. It's unthinkable. Today we are 5 trillion. 10 years back we were 1.6 trillion. Today the size of the Indian mutual fund equity AUM is 30 lakh crores, 30 trillion rupees. Exact 12 years back, 2012, the size was 2 lakh crores. Today there are 8 mutual funds who are individually managing more than 2 lakh crores. Right? 2012 cumulative size of Indian equity AUM of all the mutual fund industry players put together was 2 lakh crores. Today it is 30 lakh crores and the industry is cumulatively holding a cash of 1.2 lakh crores. So size is very different today, and that size commands respect, which is why today you are no longer a footnote in the global table of market cap. 10 years back, 5 years back, sorry, just one more point. 5 years back, 10 years back, when I used to go for my Asia road shows in Singapore and Hong Kong, we used to do 4 or 5 meetings a day. In a roadshow panning 3 days, we used to do 15 meetings, and half of the time in those meetings we used to discuss India versus China. India is expensive, there's policy paralysis, this, that, third world country, market cap, very small market cap, so rounding off error and all. Today when we go, we do 30 meetings in 3 days, and we still feel that there are so many clients we couldn't meet in this trip. Today, nobody discusses India versus China, because on a 10-year basis, China MSCI in dollar terms is down 23%, which is a CAGR of minus 1% plus, whereas India MSCI has given you plus 11% dollar compounding. So that's how big the gap is. Sorry, Sanjeev, you were making some point.
Yeah, got some very interesting points. So some questions I wanted to take up. So, one question is on the Motilal Oswal AIF that, one of our, audience, Mr. P.S. Paul, is asking that what do you feel, how will Motilal Oswal mid to mega perform after this budget? Because so that's a very specific question. But then there are also questions on the railway stocks that, would the railway stock benefit? There was a lot of thematic funds being sold, manufacturing, made in India funds. So a lot of people are asking this question, does it make sense to invest in these thematic funds or to remain in flexi caps and all? So what is your personal view? I would like to hear both of you, Gautam and Uttam. What are your views on this?
Uttam, you can start.
No, please. You may go first. It's specific on Motilal
Oswal. Very simply.
Yeah, so mid cap to mega, what do you want to say? We're putting you on a spot.
No, see, honestly, I don't hold any brief for AMC besides the fact that they're also my client, one of my many clients. So very important to categorize right at the beginning that whichever thematic fund you choose, whether mutual fund, AIF, PMS, be extra cautious of what you're buying into. What is your risk appetite? Do not jump in because your neighbor has made 3x money or 5x money. His starting point valuations were very different. 3 years back, ABB was 2,000 rupees. 5 years back, ABB was 900 rupees. Today, if you are learning the manufacturing story of India and capital goods and industrials, and you are buying ABB today at 8,500, do remember that you are paying 95 times price to earnings ratio. I'm not saying you cannot make money from this price. All I'm saying is be aware of what you're buying and at what price you're buying, right? I'll give you a simple example. Somebody spoke about railway, you asked. So 5 years back, the railway market cap, all the railway companies put together in India, I did this exercise just 5 days back. In July 2019, if you had looked at the railway companies which are listed and added their market cap put together, it was 45,000 crore rupees of market cap. All the railway companies, which was same as the market cap of Marico in those days. I'm talking about July 2019. Sorry, July 2021, 3 years back. So 45,000 crore market cap of railway today is 7.2 lakh crores, right? And Marico's market cap, 45,000 to 90,000 crores. So one has gone up 15x in 3 years, right? Almost 15x. The starting P was 8x on a trailing basis because the profits were 7 point something thousand crores and the market cap was somewhere about 44,000 crores. Today, the PE is 54 for Railway. So the price to earnings ratio for Railway has gone from 8 to 54, or rather 57, right? Earnings have gone from 7,000 to 14,000. So it is doubled in 3 years. But market cap has gone up 15x. So P rating is 5x, or rather more, 7x, from 8p to 57p. Similar data if you look at defense companies. 3 years back, total defense market cap was 1 lakh crore. Right? Today it is 11 lakh crore. 11 lakh crore. Profit of defense has gone from 7,700 crore to 17,000 crores. So market cap is up 11 times, profit is up 2x. So P, which was 12 for defense on a trailing basis 3 years back, is now 63.
Yeah, but Gautam, to be fair, there, see, defense is building up. Because of that, defense industry is very new. The profitability to increase and the valuations are actually predicting the growth and the increase on profitability, which will be take about 5 to 7
I'm
years.
not taking anything away from the defense macro thing, Sanjeev.
No,
All I'm saying is
I'm
just
not
be
supporting
aware.
that. Yeah, I'm not supporting that. See, personally, guys, I have to add in my personal view is be in large caps at the moment. I find that I would keep my personal money in large caps or flexi caps or some very So I think that's the place to be at this moment. Yes, if you're doing a SIP, then it truly doesn't make too much of a difference. But yes, so your corpus, I would say that. Uttam, would you like to add anything here? Some interesting points from Gautam. So Gautam, next till Uttam is answering this question, what do you feel is the next opportunity? That the small cap, mid cap prices have gone up so much. Where should people be putting in money? Where is that next opportunity of wealth creation, according to you, is going to come from?
I think, Sanjeev, in a market which is valued so richly like this, the pockets or opportunities are going to be very limited in the short term. So first thing first, any investor who's trying to come in today at this prices has to first necessarily extend his time horizon to at least 3 to 5 years so that he can hope to make a decent compounding by buying at this prices. Right? I'm not saying markets cannot go up in next 3 months, 6 months. It may as well go up. But all I'm saying is, from a conservative viewpoint, it is important to remain abreast of what are the current valuations which are prevailing in markets, and more importantly in sectors, and even more importantly in the stocks that you're buying. So I am clearly in favor of large caps. Incrementally in our own model portfolios, we have increased weights of large cap. Sectorally, we think sectors like consumption, IT, pharma, which have been forgotten in the last 3-4 years because there has been a huge rally in cyclicals, global cyclicals, domestic cyclicals, industrials, and real estate. The valuations in those spaces have clearly gone up by a wide margin. So relatively, consumption, IT, pharma to us looks like a slightly more safer bet. Within consumption, we think consumer discretionary is a far bigger opportunity than consumer staple, because as India grows from $2,500 per capita towards $4,000 to $5,000 per capita in the next 5-10 years, you will see a lot of new spaces opening up: hotels, jewelry, apparel, footwear, n number of things which you didn't have enough listed QSR companies 10 years back. Today there is a separate QSR analyst. Same thing for jewelry. We only had Titan 10 years back. Today there are 5 jewelry companies which are listed and 4 more which may list. So all I'm saying is consumer discretionary is like an ocean, and in a growing economy where per capita income is expected to move up toward $5,000, consumer discretionary will be a very important play. And third and most important is financials, because this space has just not participated. In the last 5 years, financials market cap is compounded at 15%, but profit is compounded at 36%. So valuations are the most reasonable today in India's financial space. And I like both private banks, PSU banks, and NBFC and wealth management and non-lending financials all put together. So those are four spaces where I see pockets of opportunities, even in an otherwise very richly and expensively valued market.
Gautam, I think wonderfully answered it, guys. So let me just explain to you. See, most of the people, when they don't get great returns from the market, a lot of people ask me, what's the difference between direct and advisory, etc., etc. See, like most of the people will go to a value file, look at which fund has given me maximum returns, and they will invest their money in that return, that fund. Now, what will happen in this market? The funds that are invested in small cap, mid cap, cyclical stocks have given the best returns. So you will put your money there, and that is what is not going to perform in the future. So, as Gautam said, Gautam gave a very clear point. It is the financial services, it is the IT, it is the pharma, it is the consumption. And that's what a research house or a Bajaj Capital does. We have tools like WealthMax, which we have recently launched. What we do is we see which funds may have underperformed, but are heavy in these segments. And these are the segments, and those are the funds we say you should keep your money for the next 12 months or 24 months. So that's where the opportunity is. And 2 years back, we were saying that keep your money in funds which are invested in small cap, mid cap, because we felt that they were undervalued. That they were undervalued. The large caps at that time were comparatively overvalued. At that time. So point is that your portfolio allocation to mutual funds also has to be forward looking, which is very important. And I think, Gautam, this point that you made is going to help a lot of people make a lot of money if they follow that. So, Uttam, let me ask you one question. There's been changes in the taxation on the hybrid funds. So, is that something exciting for people? Just explain it to people. How does that work? And, where people are, there's a lot of discussion going on that hybrid funds today have moved from 30% to 12.5% taxation. Can you explain to our viewers some stuff about that?
Right. I think what had happened is a couple of years back when the indexation benefit was taken away from debt funds. So a new category of investments, which was the hybrid funds, gained in importance because they had the benefit of the same and same as of equity. So today, as Sanjeev ji pointed out, in my opinion, the equity funds and within equities, the hybrid funds or the multi-asset categories have become more prominent, more popular, because they have the ability not only to move between different market caps, but also different asset classes. Like gold, for example, now in this budget, gold has got a booster dose because of reduced custom duty. Similarly, silver has also got the same benefit. So we need to create a portfolio which has a mix of all these asset classes, and we have a very strong portfolio review process through the WealthMax, through which we try to optimize the returns while reducing the risk in any portfolio. So it's a very superior way of kind of looking into a portfolio, how we can maximize the returns, what kind of funds should come in, which kind of funds can move out. So I think overall we need to just follow a proper portfolio approach which can help us.
And also, there's a lot of questions on gold and silver. Gautam, would you like to answer a little bit? Do you have views on that segment?
I have only one view on gold, which is that one shouldn't try to predict the prices of gold or any commodity for that matter. Now, incidentally, I've been a consumer analyst in the past, from 2007 till 2000, you can say 17, for almost a decade. And one of my most favorite stock those days and even today is Titan. Right? It's part of our model portfolio. It's part of our top 10 ideas for the last 15 years. And I have always been of the view that buying that stock over gold physical has given you better returns. Of course, you cannot hang the certificate of Titan around your neck and go to a wedding. But if you are looking at an investment vehicle and from a slightly longer term viewpoint, I think stocks which are a play on gold jewelry can give you better risk reward than pure yellow gold metal. I hold absolutely no expertise in gold and silver as a commodity class. I am just sharing this because I have tracked jewelry sector in India, which is listed for a very long time, and we've recently initiated coverage as a house on other two jewelry companies like Kalyan and Senco with buy ratings, out of which Kalyan again is part of our model portfolio. So that's my very limited perspective on gold.
No, no, Gautam, I'm absolutely in sync with you. We have recently done a jewelry IPO through BajajCapital's merchant banking division. And I truly believe that these companies, when I was going through the details, these companies are poised to do really well because consumption is increasing in India. People are getting wealthier. So my personal view on gold and silver, guys, I don't think it's a great investment for the short run. Yes, for long run, it's not an investment, but if you're buying for consumption, you're buying for self-use, you're buying for a silver coin for gifting or silver coin for keeping in your house or buying a gold coin, that's fine, or buying a jewelry. That's absolutely fine, but don't invest, just over speculate on it on as an investment class unless it's a long-term investment. And my personal view is that world hopefully should be moving towards stability now. And if it moves towards stability, then gold and silver may see some correction. So that is something that is my personal view. It may happen. Nobody can predict the market. This thing. So Uttam, now finally, I think we are at the end of it. We are in the last 5 minutes, guys. If you have any questions, please do ask this. Ask your questions. But let me ask you: if you were to put your own 10 lakh rupees in this market, where would you invest?
You're asking me?
Both of you. So this is to both of you.
Now let Uttam answer first.
Okay. Yeah, actually, it was easier for me to answer after you because I was building onto that, but that was on a lighter side. But 10 lakh rupees if I had to put today, I think not much would change for me. I would still use mutual funds as my main investment vehicle because mutual funds have proven to be the most transparent, being the most trusted way of investing our hard savings. So mutual funds, and within mutual funds, I think I would first go according to my asset allocation. I usually invest about 75% of my money into equities, but it depends from every investor to investor what should be their asset allocation, and we try and help them also with that. And within equities, then my I would be overweight now on large caps and slightly underweight on mid cap. So my large cap investment would typically be 60 to 65% of my equity allocation, and the rest would be into mid caps and small caps, but through flexi cap funds now. So that would be my first choice for investing into the markets. And then obviously there are other investment options. As an investment advisor, I would like to mention them as well. So there are market linked products in insurance category as well, which have done extremely well, like ULIPs and single premiums. Then the fixed income instruments, we should not look them away totally. We should also look at them. So there are some very good fixed income investments through mutual funds as well as through corporate deposits, like for example AAA rated ones like LIC housing, for example, and so on and so forth. And then so this would constitute most of my investments. And then not much, I don't go beyond mutual funds too much, and little bit of direct equities, not too much. So over to you.
So yeah, I mean, I'm by our internal guidelines restricted from investing in direct stocks. So I'm only a mutual fund and an ETF investor, and I keep finding various innovative ETFs nowadays. So I'm quite hot on the manufacturing theme. I'll put some money there. I like the Nifty Next 50 index fund, which is widely available everywhere, and it's done a phenomenal compounding over the last 4 or 5 years, but it is slightly more riskier compared to your Nifty 50. And then, of course, my first love has always been consumption, given that I've been a consumer analyst. So consumption is always part of my long SIPs, long-term SIPs, which I've been doing for last 5 6 years. Though it has not compounded so well in the last 4 years, given that market was more drawn towards cyclicals, but it started performing well now in the last 6 months, and I'm hopeful that over the next 5 to 10 years, it will give decent IRRs. And lastly, I also like financials, as I mentioned here. This is the most ignored part of the market right now. If you look at the valuations, they are the cheapest in PSU and private banks right now, vis-a-vis their own history and vis-a-vis the relative market valuation. So those are 4 or 5 segments where I will distribute my money. I wish I was half as disciplined as Uttam was, but yeah, I mean, we'll get there someday.
No, but guys, let me just tell you a simple tool like, which is about portfolio allocation. If you decide your allocation between large cap, small cap, mid cap, your returns will actually go up drastically if you keep rebalancing. It's one of the most simplest, and some people will even say one of the most foolish things. Yeah, what is this advice you're telling me? Okay, yeah, decide between this. But you know what happens when suppose small caps are now overpriced? What will you do? You will take the money out of small cap because you have kept a 30% or a 25% cap there. Today it's become 40%. So you put 15% into large caps, and that large cap may be undervalued. Tomorrow it goes up. So it's one of the most powerful ways to do it. So let me personally answer my question. My personal thing is that today, Uttam, thank you for reminding me that we are talking beyond mutual funds. So I apologize that we have just been keeping our conversation on mutual funds. So for me, NPS is very attractive. So for me, my NPS return is about 18-19% because probably I started earlier than Gautam. It's an amazing product, 0% charges. People talk about direct funds and ETFs. It is 30 times cheaper than even an ETF.
Which one, Sanjeev?
I'm talking about NPS.
Oh yeah, NPS.
It has no charges today.
Yeah.
So it is and today you have tier 1, tier 2, and in tier 2 you have proper equity funds also. So it's some very exciting opportunities are available there. Second is that I'm personally very fond of this new insurance product called Tulip or High Sum Insured ULIP. Okay, this is a very interesting product that has come out where you pay for 10 years and you get life cover till the age of 85. Plus, you have got an investment component. Okay, and that investment component actually gives you 3, 4, 5, or even 8, 10 times your premium back after 25 years. So you're buying a term insurance, and at the same time, people used to say buy term plus SIP. So the industry has now combined it together. But what I really like it is that you have limited payment terms and you get coverage till 85. Another product I really like, which I feel everybody should have, is a product called Legacy Planning, which is a 99-year term. Because a lot of people will keep saving money because as Indians, we want to give 5 crores, 10 crores, 2 crores, 20 crores, depending on our ability to our children. So we will not spend that money. Today, you have product where you can buy a 20 crore plan, pay for it for 10 years, and then till the age of 99, whenever you go on to the next level, your children will get it. A lot of our clients are buying it for the children. Like they have 3 children, only one will run the business, so they are buying it for the other 2 to equalize their funds. So I think this legacy planning is very exciting product. Health insurance, guys, is very, very important. Some brilliant new products where the premium doesn't increase as long as you don't take a claim. Today, if you have a health insurance, please get it reviewed. Okay? Today, you will understand the new products with much higher benefit will almost be 50% of the cost you are paying for your health insurance plan. Okay? And if you look at any emergency in a family or any family going through a tough time, it's always 80% is due to a health emergency. So don't ignore that. And finally, I think Gautam got it absolutely right. I am personally getting my research to look at funds, large caps, which are diversified large caps, which are heavy on consumption, heavy on financial, heavy on IT, and heavy on some other segments don't want to give the whole secret formula out. But and those funds are not the top performers now, because that strategy hasn't worked for the last 1 year. So today they will be in the lower quartile, but I feel they'll do well. So that's how I'm investing my money. So we are at the end of the time. Some final words from you, Gautam and Uttam, and then we can close the conversation today.
Yeah, no, thanks for having me here, Sanjeev and Uttam. First things first, we are at a juncture where markets have already done very well in the last 4 years. So it's very easy to get sucked into this market if you've not been a participant. Before you get into the market, do pay attention to the relative risk reward, valuations, your own time horizon of investment. Second, if you're already invested, my humble advice would be to stay invested. We haven't seen anything yet. In the US, when the bull market started in 80s, it went on for 20 years. I'm not drawing any analogy, but I'm just saying how often we can go wrong on both the extent and duration of the bull market. And clearly, I mean, 6 months back in February, we were trading at 21,000. It felt expensive then. Today, we are trading at 25,000. It is again looking expensive. So don't take the judgmental call on valuations, because bull markets are all about creating excesses. And that is what helps in the long term to balance your compounding. The overall long-term compounding is a function of three parameters: how you did during the bull market, how you did during a market which is flatlining and sideways, and then how you did during the bear market. So if you exit out of the bull market too early, your long-term compounding is going to suffer, because you will participate fully in the bear market and the sideways market. So why not participate fully in bull market as well, as long as you have the gift of time in your hand. If you don't have enough time horizon, then it is very important to follow a very judicious asset allocation, which a lot of celebrated wealth managers, and there are a lot of financial influencers, and good amount of data and knowledge and insights are available on how do you balance your asset allocation. So in the quest for making big returns, sometimes we forget the asset allocation part, and I think that is very important. And at the same time, must also say, while I have been fully an equity investor and my job involves only equity, it is important to have multiple assets in the portfolio, so that when one asset doesn't do too well, at least you have some other complementary or competing asset which takes care of your overall net worth. So those are 2-3 points on which I would like to end. I wish you very well in your wealth creation journey. Good evening, and thank you so much.
Yeah, Gautam, I think beautiful answer. Beautiful.
Great. I'll be very brief. That in my opinion, the India growth story is very, very strong. And I think we have been in a bull run for not last 2, 3, 5 years. It's been 40 years now. Our markets have given 16% XIRR in last 40 years. So this is one of the very few developing countries which has shown this kind of returns. And I think it is the journey is still intact. So we just need to stick to our investment goals, plans, and enjoy this journey of wealth creation together. So that's what I wanted to say. Thank you so much.
I'll just quickly say, look, guys, the best is yet to come. And a lot of people are asking this question: where to invest, what to choose. So I'll say choose BajajCapital. I hope we can give you good advice, and we have helped create maximum number of crorpatis, and maybe we can help you become a crorepati or a multi-crorepati. But if I was to give one quick advice, my personal fund type at the moment is a multi-cap fund. Okay, because I think multi-cap fund helps you do asset allocation automatically. So multi-caps, please do look at it. I think it's a very interesting category. And there's the new high-risk category of funds which have been introduced, 10 lakh plus investments. So that is also something I'm really looking forward to. And, so that is going to be exciting. So thank you everyone for joining us today. Thank you, Gautam. It was awesome. And guys, everybody who heard us today or will hear us on YouTube, we hope we have helped you make money. Thank you.
And thank you, Sanjeev ji. Thank you.
Sanjeev. Bye.
See you, everybody. Bye.